Broker Daily Uncut.
Broker Daily Uncut.
News, views and opinion about what's shaping Australia's mortgage and finance industry.
Good morning, everyone. Jack Campbell here, and welcome back to another episode of Broker Daily Uncut, joining you from a chilly Monday morning, the second day of winter. How you feeling, Phil?
All right.
You're all rugged up in your...
I know. It was cold this morning, and it was foggy.
Yeah, it was.
Like the whole city was blanketed. You could just see like the tip of the Salesforce Tower and what do you call it, Centre Point. It was, yeah. Every now and then, a couple of times a year, you just get this huge blanket of fog coming through, and just sat in the harbour, and it was pretty sticky. So yeah, it's a bit chilly. Unlike yesterday though, warm. It's great.
It's good.
Great day.
Good for a
22
Sunday.
degrees. Yeah.
Yeah, Paddy and I were just saying behind the scenes here.
Who's Paddy?
Broker Daily Uncut. He's our master mixer for the podcast, coming over the Harbour Bridge, and you couldn't see a thing, couldn't see the water, couldn't see the Opera House.
Yeah.
I like that view coming over the bridge. That's one of the
Great
highlights
views
of
the
my
world.
Monday morning.
Great views of the world.
But yeah, it was doing without it this morning, which was a shame. But cracking back into the news, another week. It's just us two today, no Alex. But if you follow the bulletin, if you get the breaking news to your inbox, you would have seen as of this morning, 76.8% market share for mortgage brokers in Australia, a new record high from the MFAA. That data came.
Wow. There you go.
And it's what's that, 2.7% increase year on year. So it's steadily climbing.
Did they release that this morning?
Yeah,
Okay.
that was 9:30 this morning that came out. Exciting news, 0.8% increase from the last quarter. And, you know, according to the MFAA, Anya Panek had a bit to say following the announcement. And since the February rate cut, first one in over 4 years, the activity was just
4 years?
huge. Yeah, it was
First cut in 4 years.
first cut in 4 years.
That's probably about right. Yeah.
Yeah, so activity obviously on the increase, people taking advantage of it, and now the May cut, well, that wasn't factored into this market share. This was for the March quarter, but sure to be on the come up even more and more as people are jumping.
What's the number?
76.8.
76.8. Yeah. How high will it go? That's it.
Yeah, well,
it's going to crack 80.
well, that's what you guys were saying not long ago. You think it was stagnated 80, you were saying?
Yeah, it sort of feels like that's where it will probably tap and cap out. But look, I think it'll hover around that and might go up or down. But, you know, the broker market share just continues to grow. I remember when I started knocking around mortgages, it was about 30%.
Oh, wow.
So it goes to show how long I've been sort of in and around mortgages. We always knew it would grow rapidly, and you know, hence the reason why in many ways we've sort of backed the growth of the sector through products like, you know, Broker Daily and Advisor and all the events that we do. So it's good to see Australian consumers are still choosing mortgage brokers other than going direct to banks. And I've seen some really good coverage over the last week or so around it. And, you know, we had the CBA broker head in here pretty much saying, hey, look, we're concentrating on the broker market as well as growing our proprietary channel and also growing our digital channel. And I think our colleague Annie Kane had a very similar conversation with the head the other day, pretty much echoing that. So, you know, every lender is going to try and drive across all those market areas which are critical and key to them. And Aussie consumers are choosing brokers. So I'd like to think that lenders are taking the broker channel as a real serious driver of flow and volume for them and continue to invest in it. So it's a good sign, mate. It's a really good sign.
Yeah, it is. It's good for the industry, and I know a lot of the people we chat to will be happy that their hard work is being recognised by the Aussie borrower.
Well, sure it is, but this is you know, sometimes you've got to question the motives of people. The story I saw in the Financial Review, it's the last week or the week before, I can't remember. You did a piece on it last week around it, and it was pretty much, and look, this is a well-worn path. Every sort of year or so, you get a story like this coming out, and I think the story, to paraphrase, if you're not across it this time around, was, and the journalist, Jack, you can probably help me out with that. McDonald by memory, was it?
Yeah, McDonald was the surname.
Yeah, it was Anthony McDonald. And you know, why you get these stories, I'm not too sure, but it was pretty much posing the question, if we cut the middleman out, so I think that's the language they used, let's cut the middleman out of mortgages and it will make mortgages cheaper. And the position was, if we actually got rid of mortgage brokers because they're paid, and I think the number they used was pretty generic, $1 million loan, so yeah, $6,000 in commission. If we got rid of the middleman and you just passed on that savings to the borrower, mortgages would be cheaper for all Australians. So you get a story like that, and everyone in the industry now just sort of shrugs their shoulders and just go, okay, here we go again, right? But on the flip side, we saw it coming out today, 76.8% market share of mortgage brokers in Australia. So really,
Yeah, it doesn't really fit, does it?
Like, come on, right? And I see again the industry now is pretty sort of skilled now at responding to these type of stories. You had a bunch of people commenting on your piece. I think Troy Phillips, for example, over at First Point there, pretty much just going, it's just fantasy.
That
come
was
on, nothing to see here. Let's move on.
For his comments saying it was fantasy, because that's what stuck out to me in the article. I mean, I can't imagine lenders passing on savings from commissions to the borrower, and obviously people agreed with me, and there were a few heated comments in the comments section. But then we went out and spoke to the lenders, the head of third party, who you were just chatting about, Barbara Zaka.
Yeah, with CBA, yeah.
Yeah, and we had Adam Brown jump on, and a spokesperson from ANZ who all reaffirmed.
Barbara would have said the same thing. Hey, look, we're going hard in all channels.
Yeah,
including brokers. He looks after brokers. They'll do what they can. But I think people are now a little bit fatigued by it all, and they're just going like, I ask, why would that story be put out? Who is that benefiting? What's the objective in doing it? Is it just to create some noise or discussion, or just inflame, the sector again, or is there something a little bit nefarious going on there? I don't know. As a lender got into the journo's ear and said, "Hey, look, he's a good story for you. Do this, right?" Or is it just a journalist that doesn't know? Like, there's a lot of journos who don't know anything about mortgages, right? Particularly the third party channel. It's quite specialist. But you ask most journos around, they think, a mortgage is more expensive because the mortgage broker writes it. Oh yeah, of course it is. Like they'll put you into the wrong product. They'll put you wherever they get the highest commission. That's the stuff you still get.
Yeah, I think a bit ill-informed, that article, but I mean, as both journos, we love a spicy piece now and then.
It's good to have a crowd. Like, it's good just to just go. Everyone sees it and just goes, yeah, okay. But I think the commentary I saw around it from within your piece and also other CEO of Lendy, for example, is pretty much going, okay, well. It costs the bank just at upfront $6,000 to originate the mortgage, right? And his position was for the digital and proprietary channels. Well, bank branches are still pretty expensive to run and operate. Hence the reason why they're being rolled back at a rapid rate across all the banks. Digital mortgages, right? Yes, it may be less computing, less people power to compute a mortgage, but the cost of origination to find someone to do a digital mortgage for potentially is a lot more expensive than $6,000 a broker gets paid. So, this was the point. It still costs money to originate a customer, and I think the Lendy CEO was talking about, the cost of Google ads and Facebook advertising and all this sort of stuff in order to originate
staff and having software in place, and
it's crazy. And maybe that's the opportunity is actually how much does it cost a bank to originate a digital home loan? Is it more than the broker channel, considering an upfront commission and what's the average life of a loan? Not many of them actually run out the 25 years, right? They get refinanced at some point. Potentially an argument, if you break it down, I don't think any bank will ever want to do this, that the broker channel is probably pretty competitive. It's a competitive place to originate home loans, particularly when the majority of Australians, a growing majority of Australians, want to use a mortgage broker for originating a mortgage, 76.8%.
It was timely that the MFAA
data
came out.
Maybe they were just sitting on it, and maybe they were sitting there going, let's wait and find the right time to release this, because we all know the interest rate cut last month, and I would imagine a lot of the banks were quick out of the blocks to pass on those savings. So I imagine most Australians will start seeing those rates pass through this week.
Yeah, they've started coming through already. I think a lot of them were between the 26th of May and now the 2nd of June.
I haven't checked my it normally takes a couple of weeks. They don't go that fast, but it takes some time to notify everyone. But it should be around now that all those rates are passed on. So it's an interesting time. I was reading the paper today. Maybe we can get into it. Around how this is really going to accelerate positive growth in real estate markets. But
Well, we definitely will get into that, but we've got to throw to a quick break. We'll be back after this. And we're back with Broker Daily Uncut. Now, I haven't seen reports or anything, but I've just been hearing rumblings, and you said that you saw something this morning on the impact on property prices that these rate cuts have had. Now, Alex and I were talking last week about how following the February rate cut, pretty much all lenders implemented the interest rate reduction, and then following the May one, it seemed they were even quicker out the gate to implement it, which was a good sign, but obviously there's going to be repercussions from that. And you were saying you noticed some reports that there were an increase in property prices following those two cuts.
Yeah, when I stop for my morning coffee, I normally pick up the paper and sort of see what the headlines are. And I, this I saw a piece in the telly, which I always read because it gives you a different lens of things than what you might see maybe at the SMH or the Australian, some of the other papers. And the story here was Sydney's medium home approaches 1.5 million after rate cuts. And this is data that come out of PropTrack's latest home price index, which was today, shows median price of dwellings based on sales units, townhouses and houses rose 0.36% in May. So, we're now knocking on the door $1.5 million in Sydney, and they're saying essentially positive changes to interest rates are going to accelerate sort of property house growth over the period ahead, which most people are telegraphing, and it's a consequence of a whole bunch of things. One of them is cheaper rates, but we've spoken about the election and some of the stimulus there are coming out of it as well. But this is where we are. This is the environment. This is the cycle. Most mortgage brokers now to be right across this because, refinance and business I think is going to be strong moving forward. People looking to potentially maybe leverage equity to get into new properties and or, shift their principal place of residence somewhere else, upsize, downsize. So this is where we're at. But again, there's lots of other sort of fringe factors which are shaping this. I think you did a piece here on Broker Daily. Borrowers access over 20% more borrowing power from HEX debt servicing changes, right? You take that consideration, we'll have a chat with that, but you look at that running in parallel with it, the forgiveness that cost the Australian taxpayer, it's going to cost the Australian taxpayer $16 billion to forgive, was it 20 or 25% of all the HEX debts of all Australians, right? So This is, again, going to be a huge amount of stimulus to put people into the market sooner. We still haven't solved the supply side of things, so the consequence is stuff's going to get more expensive.
That's a depressing figure, 1.5 million as the median house price. I know it's, you can go to different areas and get it far cheaper, but another piece we ran last week was recognising the property prices up, but building approvals down. So it's slowed down. I think the ramp up to the election, everyone was jumping on the building approval train, and following the election, they're seeing a drop. It's not an encouraging sign for the supply of houses.
We're already behind. They're telegraphing. They, as in sort of commentators, telegraphing we're going to fall quite well short of the ambitious 5-year target that we have. Right. So it's all being manifested by a lot of the supply chain challenges. But we're accelerating people into home ownership sooner through a lot of these sort of stimulus changes. And policy changes. It sounds as though the CBA sort of HEX debt serviceability has really empowered people to borrow more, is what it's done, and maybe get into the market quicker. But all of these, again, sort of second, third, fourth order effects are going to shape sort of borrowing behaviours and habits, and there will be an upwards consequence on prices as a result of it, which is great if you're a property investor, which is I am.
Yeah, not so
maybe
great
not
for
so
me.
good. Maybe not so good when we're sort of trying to make housing more affordable.
Yeah. Well, if you missed that one, that was the we had a report come in. CBA implemented the APRA recommendations for HEX debt servicing changes, and what was that for the next 5 years? If they had HEX debt to be repaid within that time frame, it was a 1% serviceability buffer rather than the 3%, and it showed that those who were eligible for that would receive a 21.19% more borrowing power. So it was a pretty niche offering, but for those that are able to access it, pretty powerful tool. But again, all these initiatives to get first home buyers into homes, and it's a bit of a scramble at the moment. We had auction results that got sent through, and it seems like people are jumping on board and jumping into the market, which is a good sign, but also for someone who isn't quite ready there, it's not quite as encouraging, is it?
Well, this is it, right? You can't do one thing over here and not think that you're going to get a consequence somewhere else. So I don't mind this sort of policy tweak in some ways. I think it's sort of smart to sort of play around the fringes of HEX debt. Now, a HEX debt is a loan that needs to be repaid. Now, yes, the government's going to forgive some of it, but it's still an incumbency on whoever has that debt to pay that debt down. So I would say it's sort of prudent to pay that debt down before you take on more debt, or not have a contingent debt that still needs servicing, which may affect your ability to service a mortgage. But there is some common sense around this, I believe, and I think this particular policy from the policy around this with CBA is that if you're in your last year or so of paying down your HEX debt, they don't assume that you've got any debt as well. And I sort of go, yeah, I get that. If someone showed discipline and smart budgeting to pay their debt down, it's hard to pay your HEX debt off just through contributions from your salary, right? You're going to be doing it for a long time.
So you were making extra payments with yours?
Of course, absolutely. Yeah. Well, as soon as I got into a position where I could actually pay my HEX down at an accelerated level over and above just what was garnished out of your salary, yeah, absolutely. But no one really talks about this. Everyone talks about how to pay off your home sooner or how to get in the market sooner. There is very little commentary around, hey, pay your HEX debt off as quickly as you possibly can. For a whole bunch of different reasons. One of them is the financial consequence of it is that you're going to have more money potentially to service a home loan. But from a mindset point of view, it's to actually tick that off and go, I've got that debt. So for a lot of people, it's like the sort of Damocles hanging over their head, saying, I can't do anything else until I've got this HEX debt removed. And if you think the best way to pay off your HEX debt is to have it sort of taken out of your salary, it's going to take you a long time, and for younger people, when you start, finding a partner, if that partner also has a large HEX debt and you choose to enter into a long-term relationship with them, that HEX debt also becomes your HEX debt because it's probably going to stifle your ability to save money in order to enter the property market. So, Aussies should be trying to pay off their HEX debts as quickly as they possibly can, because it's just going to be an enabler for them to actually make more informed and more active financial decisions elsewhere. That's why I've said one of the great policies the government could introduce is to don't only focus on helping parents get your kids into the property market sooner. I would be providing incentives in some way or another for parents to help pay off their kids' HEX debts. That would be a really active and focused strategy to get all the consequences of that, which I've just outlined. Give parents a tax break to pay off their kids' HEX debts.
Well, people do hold on to it.
But the cynic in me says that the government's getting interest repayments off HEX debts, right? They're a lender.
Well, people do hold on to it. I've got an uncle who's in his 50s and he only paid off his HEX debt a couple of years ago. He held on to that for a long time. I mean, he had a lot of loans out. He was, not working too much when he was through uni and partying probably a bit too much. But, that's 30 years.
You don't want to kick it down the road. And it's been indexed right on CPI, yeah? HEX debts. I haven't looked at it for a long time. So most they've been paying a pretty hefty interest rate on their HEX debt. I'd get rid of it. And if you're a parent and you have kids with HEX debts, probably the best thing you can do is help them get rid of their HEX debt.
Well, there's one for your parents. If you want to help your kid get some more borrowing power, help them in the long run.
But you think about it. Imagine you go, I've got 20 grand left in my HEX debt. And then you meet someone, they've got a $60,000 HEX debt. Like, that's just, if you choose to enter into a long-term relationship with that person, that HEX debt, their HEX debt, is going to hamper your ability to enter the property market.
Oh, I've got to be honest, I haven't even looked at my HEX debt, so I don't know what I owe, but I think you've inspired me. Yeah, I know. It's got a out of sight, out of mind.
Get rid of it. Get rid of it. Even if I were the government, I would actually give tax stimulus. If you want to get Australians into housing earlier, actually direct the policy to supporting Aussies pay off their HECS debt. It's incentivise them to pay off their HECS debt for all the reasons I've just outlined.
Yeah, well,
you know, and I tell you what, here's another aspect of this. If you want to get, you know, down to the minutiae of the consequence of HECS debts, people are probably going to not start families sooner because they have a HECS debt. They're going to sit there going, we can't afford to have children because we still have this HECS debt. So at a nation building perspective, it's probably slowing Australia's birth rate or the speed at which we can actually grow the country through population growth, and we all know that we need to, you know, keep doing that because of HECS debts. Like, you know, it's a crisis. It's a crisis around this right now.
Counter argument there though. The more people that you've got, the less housing supply you've got, adding to the issues.
And this is the cyclical question, right? You know, does the government can't build enough houses, right? So, you know, the cynical journalists, as we are, you go, well, they don't want too many more Australians wanting really to enter the housing market because there ain't enough houses. So we'll just keep it there as it is right now. It's a very sort of cynical way to view it, but
that's the tinfoil hat way.
I know, but just think about it, right? Imagine if there's a whole bunch of younger Australians unencumbered because you've released them from the shackles of a HECS debt. The next thing they're going to want to do is start families and buy houses.
Yeah,
there's not enough houses.
Exactly right. Well,
cynical
journalists. That's what we are.
But by the way, that's not my personal view. I'm just saying it's just one lens that you could look at this through.
Yeah, definitely. Well, there's a lot of factors going into it, and it's a little bleak sounding the way we've put it, but it's not all bleak. There are good news, good stories to come out. We'll get back to a few of them. We'll just go to a quick break. We'll be back after this. And we're back with Broker Daily Uncut. Now, I promised we'd have some good news. It seems for commercial finance brokers, busy times ahead. Small business loans surging following RBA tax cuts, RBA interest rate cuts, So small businesses taking advantage of reduced rates and bolstering that industry. It's good news.
It's not bad. It's good for brokers who are sort of writing commercial deals to be aware and conscious of that and making sure they're engaged and connected or upskilling their capabilities to service their SME clients. Look, you know, most Australian businesses, irrespective of how strong those organisations are, most businesses in time have some sort of cash flow oriented issue, whether it's they're investing for growth or something's happened or they've got a seasonal type of revenue. So being able to service that sector is key. But what I think it says is that as soon as interest rates coming down, you just get just an organic and if not instant sentiment shift to people where they go, oh, things are getting easier. So when it's like it's getting harder, it really shapes mindsets. But when you just get these little, it's like a pressure valve of which just release a little bit and people go, oh, maybe things aren't that bad. And they'll shift it from being austerity mode to potentially growth mode. And how do you grow in business? Well, typically it's through investment. And, you know, if you don't have strong cash flows or a strong sort of balance sheet or you've got your capital deployed elsewhere, often finance is a great mechanism for doing that.
Yeah,
so,
and it's not exclusive for businesses, but, you know, the most Australians who aren't in and around the industry look at the RBA decision as what they're going to do in the future. That's their future planning tool. I know mates who have mortgages who don't know anything about the industry or interest rates or anything like that. They just look for the RBA announcement and that's their factor on how they plan their year ahead, which might not be.
So, but they'll go, oh, wow, things are getting easier.
Yeah. That's like the little serotonin switch that
it's absolutely a serotonin switch, and no doubt someone should do. Maybe it's already been done. Someone should do a PhD on the psychology of interest rate reductions in decision making and all this sort of stuff, right? But it does have a huge bearing, you know. And business confidence is critical. If businesses think things are better than what they were, they'll make hiring decisions. I'll tell you what, when things are better, businesses have a greater appetite for investing in their people. No, they go, okay, well, you might go from no pay rises to, okay, well, we're going to, you know, things are getting better and the market's looking better and therefore, you know, it can shift things. And that has a consequence, right? More money in people's back pockets.
Well, it's far reaching, you know. You look at the news that we put out and the constant cash rate holds or cash rate increases. It's getting pumped out across the media. That's what people are seeing on their day-to-day when they're tuning into the news, and it's a mindset.
It is mindset. A lot of you got to put things in perspective. And a lot of people think Australia is all about big business. Or if you look at the business, the business pages in a paper or on the news and the headlines, right? You would always see the big companies and what the big companies are doing. It's what gets the headlines. It's largely what gets the time and the bandwidth of the current government. But and I might butcher these stats, and I'm just rattling them out. I think 97% of all businesses in Australia are small businesses. That's like less than 20 people, I think. It's Australia is the Australian economy is built on the backs of small businesses. I think they employ, they don't employ that percentage because you've got those big businesses, but they employ the majority of workers in Australia are employed by small businesses. So if you have strong small business health and you have healthy appetites and sentiments within small businesses, I'll tell you, the people that work in and around them, their employees, probably have a better go at it as well. So this is why stuff like this is important. And if there is access to capital for growth, rather than just maybe alleviating some of the stress, the pressures of stress that a lot of small businesses have, you got to remember there's a lot of small businesses in Australia who, there's like zombie firms, right? They probably shouldn't be in business. They just sustain in some way or other. But small business is critical. It doesn't get the emphasis, and it doesn't get the support, and it doesn't get the bandwidth that it needs from the current government.
Yeah, well, all the headlines and data and stuff that we've been seeing lately around small businesses, it's looking positive. It's end of financial year. They'll be planning for the future ahead. And with interest rate cuts coming in, it's a bit of relief for them, I think, much needed following all the dramas of the pandemic and what that caused. So encouraging signs, but unfortunately that's all we have today. Thanks again for tuning in. If you want to visit more content, visit brokerdaily.au. Reach me directly if you have any queries or any story ideas. editor@brokerdaily.au. We'd love to hear from you. We'll chat to you again soon. Cheers.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.